The S&P 500 just closed at 5,000 for the first time in history, and a lot of people are starting to worry about what comes next. So how should you prepare for a year and where the markets are priced so high? Coming up on the Fed Corner. It's no surprise that people are expecting another bear market soon. This is what drives attention, after all, and frankly, they'll be right sooner or later. But today, I'm going to create some context for you so that you can understand how professional planners like us view this kind of thing. And I want to start by pointing out that by the end of 2008, the S&P 500 was around 800 at the time, and the Dow Jones Industrial Average was just under 9,000. And the NASDAQ was about 1,500. And over these 16 years, there's been a lot of things that have happened in the economy, in the markets, and in the world overall. But from on top of the mountain, we look out, and today, we're looking at an S&P 500 of 5,000, a Dow Jones of over 38,000, and the NASDAQ of over 16,000. And the entire way up, there were countless reasons for you to hang on to as justification for not being in the market. It was another recession. It was the markets are overvalued. It was Brexit. It was COVID. It was the Fed every other day. Another recession, elections, you name it. But what you need to understand is that it's time, not timing, that matters most when it comes to growing your wealth in the long run. Now, to be fair, there has been tons of volatility over the last 16 years. I will admit to that. In fact, if you were retired during these 16 years and you really weren't careful about your income system and how you were drawing money in retirement, there were many times that you could have caused yourself a lot of trouble and possibly ended your retirement early. So being aggressive and staying aggressive through everything is not the answer. But volatility is not the problem either. The problem is how you're set up for volatility and the actions that you take or don't take during the ups and downs of the market cycles. This is where retirees most often get themselves into trouble and miss out on a lot of potential value. Pretty soon, we're going to be talking about another election cycle and how the markets are going to be reacting again. And I know I'm going to talk to some Feds who are going to say, hey, we went to the G fund because it was just uncertain. We didn't know what was going to happen. The economy was going to fall apart. So I want you to check this out. This chart represents if $1,000 had been invested in the S&P 500 index, hypothetically. We go back all the way to the 1930s, and regardless of which administration was in power, which party was leading, which election cycle we were in, US stocks have trended upwards the entire time. Yes, there was definitely volatility in a bunch of different places, and that was really hard to deal with, especially if you were already retired. But over time, markets have always bounced back quickly during election cycles, so this too is not a reason for you to sit out of the markets. The fact is that there is always something looming. Tech stocks have pulled the markets to the new highs that they have now, and the fact is that they've been the leaders over the last decade and a half. So of course, everyone is saying that technology stocks are in a bubble right now. And we can't possibly know if technology stocks are going to sell off next week. Are they overvalued from a technical perspective? Heck yeah, but they were many times over these last 16 years as well, and look at where we stand today. And that's the key here. Being overvalued may very well mean that we're going to see volatility again, but you have to remember that volatility is risk in the short term and opportunity in the long run. So listen, if you have a decade or more before you're going to retire, or before you're going to touch a portion of your portfolio, then you shouldn't be worried so much about what happens intraday in the markets and trying to preserve your wealth. If the Fed keeps rates the same or cuts later this year is going to mean so little 10 years from now when you look at the grand scheme of things. If you get scared out of the markets and you miss out on just 10 of the best performing days in the markets, you've missed out on the majority of that actual growth. Think about how many people sat out of the markets in all of 2023 waiting for that next recession to come. Everybody was telling us that there was a recession coming, that there's trouble in the economy. And don't get me wrong, you do need to remain defensive, especially if you are later in your career. But this does not mean that you pull out of the markets altogether. That is where you get yourself in trouble and miss out on whatever the S&P did last year, which was something like over 20%. Think about how many people missed out on the growth that was available last year in the markets, which was desperately needed to recover from the pandemic. And now think about what is the potential long-term impact to their retirement plan if that happened to them. Now, I want to make sure I don't gloss over something here. If you have less time because either you're retired or you're close to it, then much more finesse is required of you. There are always parts of your portfolio that have to be inflation fighting and replacing some of the dollars that you're spending in retirement. To our clients, we call this their growth bucket. There are certain asset classes that do really well in helping protect against inflation and outpace that spending plus inflation. So you want to be sure that you incorporate some asset classes that help you not run out of money. But then there are also buckets that create stability for you, because if you're drawing from a portfolio in a retirement and the markets are crazy volatile, that's not the time that you want to be selling investments at a loss. So how should you address this as a retiree? Waiting for the markets to recover is always a good strategy, but if all of your portfolio is down something like 25, 30, 40%, then that can be challenging to think about how long it's going to take for you to recover to where you were. What's worse is, what if you also need to take money from your portfolio when the markets are selling off? In fact, this is one of the biggest risks to a retirement plan, and it's called sequence of returns risk. So if your portfolio is too aggressive as well, now you're on the other side of the spectrum and causing yourself harm. So as a retiree or someone who's close to it, where do you fall? How can you tell where you're supposed to be? Should you be more growth oriented because maybe you have more time or you've not saved as much as you needed? Should you be more stability focused because you have enough and now you're looking for that consistency? Somewhere in the middle? What you want to do is think about how much time you have before you need to start touching some of that money. The concept of buckets is very simple to understand, but not so simple to implement. The idea here is that you want to consider how much money you're going to need soon, in the short term, medium, long term, ultra long, however many buckets is appropriate for your plan. And the longer that you don't need your money, the more tolerance for growth types of investments, which bring volatility, you can have inside your own portfolio. And as you're spending your money over time and living in the day-to-day, you're using that from your short-term buckets. You're refilling them over time whenever it makes the most tax sense to do it, whenever it makes the most market sense to do it. I don't want to spend too much time getting into this. I just wanted to introduce the concept. If you're thinking about, man, how am I going to really address my needs in retirement without so much risk? And once you have your bucket strategy, then you can think about how much belongs in each bucket and what allocation is going to be best appropriate for that bucket. Something that's very short-term is obviously going to be cash-heavy, short-term bonds, short-term treasuries, all kinds of different instruments out there that allow you to meet your short-term needs. The further out you go, those tools that you have available to you begin to change, and so should your strategy to meet your objectives. So focus more on having a solid plan rather than what's going on in the markets day to day. Your retirement plan and the proper implementation are far more important than trying to get the timing right to miss out on the next bear market. You can create a plan that is successful through bear markets as long as you're doing it correctly. And if you don't have your plan yet, we're opening up availability to a select number of families that are interested in working with us this year. So if you're retired or you're right up on retirement and you want to know how you can apply, check out our website at thefedcorner.com. Until next time, stay wise and stay wealthy.